Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here for another special report following this month's Federal Open Markets Committee guidance, followed by the press conference by Fed Chair Jerome Powell. As usual, I am joined by money manager and Fed expert extraordinaire, Axel Merk. Axel, how you doing?
Good. This is a wonderful relief for a busy day to talk with you.
Thank you. Well, again, I appreciate you taking time in your busy day to make sure that you help make sense of everything we just learned today from my audience. Very quickly, Axel, this one seems like not a lot of surprises out of this one. As expected, the Fed held its main policy rate unchanged at 4.25 to 4.5. Maybe the one bit of news here is that they cut the pace of quantitative tightening in half. They basically are going to be slowing the roll-off of U.S. Treasuries from the balance sheet. They're going to continue to roll off mortgage-backed securities at the same pace. A fair amount of talk about the uncertainty, the higher level of uncertainty in the economy right now. A lot of talk about tariffs and, of course, the disruptive Trump policies. Long story short, the Fed is increasing its forecasts for inflation for the year, decreasing its forecasts for economic growth, but pretty minor changes, increasing its forecasts for unemployment, the unemployment rate, again, minor changes. Not a lot of bombshells this time around. At least that's how I saw it. How do you see it?
There is a little bit of a bombshell in them not doing anything. Remember, historically, when the economy slows down, the Fed would become more dovish and cut rates. And indeed, many people said it was dovish. And I think it was Jonathan Farrow on Bloomberg who said, wait a second, this is hawkish. And the reason why he said it's hawkish is that this is stagflationary and the Fed is not doing anything. There is no Fed easing here. You mentioned it, right? The economy is slowing down in their assessment. Inflation is sticky, maybe picking up a tad. And guess what? The Fed is staying put. And so historically, when the economy slows down, the Fed would ease. And no, they're not doing anything. Now, question maybe why they're not doing anything, but I think that's the first noteworthy thing. The second one is you mentioned all the tariffs and everything. Are they not doing anything because they're so super brilliant, or are they not doing anything because they are like deer that are facing some bright headlights? And I would suspect it's a bit of the latter. He was asked sometime during the press conference what they think about the tariffs, and then Powell was talking, oh, we got all these models and everything. Well, I think the truth of the matter is that, yeah, they may have all these models, but they don't know what to do with them, because they have decided that they have no idea, and the best course of action is to do nothing. Now, they can do that because they think in a somewhat reasonable space, because they're slightly restrictive and all that. But I think as far as bombshells are concerned is that, yeah, they say we have stagflation.
Well, a couple of things. One, that word I don't think went out of Jerome Powell's mouth. I didn't hear him mention the word stagflation.
He pushed back against that. He was actually asked by one of the journalists, so do you want to try to avoid a repeat of the 70s? And let me see whether I find the quote here. As you're facing slower growth and higher inflation, are you heeding the lessons of the 1970s? And then he said, I don't see any reason for a replay of the 1970s. And he went on and it said, it's not remotely similar.
No.
Yeah, it's nowhere close to that. So, of course, he wouldn't say that. If you, we're going to talk, I'm sure, about gold a little bit later. If you lay over the gold charts in the early 70s with what's happening now, there is a similarity. Now, correlation doesn't create any predictive force, of course, but to shrug it off entirely is may not be prudent. I mean, for a Fed chair, of course, it might be the right thing to say, but it's not necessarily the thing that I would count on.
Well, let me ask you this. Now, of course, part of the Fed chair's job is to project confidence. But many times throughout the press conference, he said look, we feel like we're in great position. We're close to our targets. We don't feel any time pressure to move before we need to. We feel like we can just wait and see how things unfold and then react to the data. He did say, look, we're less confident in our forecasts because there's so much uncertainty right now, but we're very confident in our positioning and our ability to take the right action as needed. Do you think that that is more like he truly believes it, and if he's wrong, it's more hubris? Or do you think that that's more just like, hey, I got to say this, even though maybe inside I'm a lot more nervous?
It's forward guidance, the stuff that we have thrown out and don't embrace anymore, right? It means we're not going to lower rates, we're not going to hike rates, we stay put. That's what that means. And they're supposed to be dependent on incoming data and whatnot, and instead they're saying we're not going to do anything. So they are doing all the things. We've talked about this many times. I'm alleging they don't have a strategic framework.
Right.
Indeed, this environment shows that they're just hostage of, I call it a debating club, right? And so they will be late. Dudley, the former New York Fed president, he said there's a risk that they're late. Well, no kidding, right? They aren't doing anything. They wait for tariffs or whatever Trump policy is going to be, or deregulation or whatever we'll have to take place. And then they'll think about what it might mean. And then maybe they will act. All of that is by design reactionary. And keep in mind, they're currently undergoing their 5-year review where they want to greatly improve how they communicate and what they're doing. I haven't seen anything where they even admit that this process is seriously flawed.
So somebody from Bloomberg Radio and TV actually specifically asked him that about, hey, you've been often criticized for being behind the curve. What can you tell us going forward that you're going to actually be able to get out ahead of these things and not just be in reaction mode all the time? And Powell just basically said, hey, we're super confident. Again,
that was Craig Torres, by the way, one of the best journalists that Bloomberg has. He's been around for a long time, and he asks good questions.
Okay, so great, very good question. Are you basically saying that Powell's answer was more, again, just sort of hubris? Like, trust me, I got it, even though you're not seeing any signs the Fed's going to act any differently than it always has?
Well, the poor bloke, what's he supposed to say, right? My view is, why on earth have these press conferences when the only thing you can do is make a mistake? Right? You talk to the public when you got to have something to say.
Right.
Not
and
simply
just to interrupt, but just
for
for folks watching who haven't seen our past ones, you have been beating this drum for a long time, both about the Fed's lack of a framework, but also you just don't think they should be saying anything. Like, don't give forward guidance, don't talk, only come out if there's something really new to say, but otherwise just don't get in front of a microphone.
Yeah. It's the reason we listen to this is, of course, and I've said this many times as well, because they have the bazooka, right? And by the way, we might get to that. The Fed is currently actually much less relevant for the markets than they have been. In some ways, that's a good thing, right? We're not all focused on where the monetary policy is going to be the next 5 minutes, because we have other things to worry about. Now, whether that's always necessarily good or bad, I don't know, but it's good that the Fed is somewhat on autopilot.
Okay, so good that they're not mucking around too much right now. You just mentioned the word bazooka, and I know, ever since the global financial crisis, when Draghi pulled out his, whatever it takes bazooka, we've talked about how you have to listen to the Fed because they're the kid on the block with the bazooka. If somebody lives in your block with a bazooka, like them or not, you got to pay attention to what they're doing. You mentioned the Fed's not quite as important as it used to be. And where I'm going with this in terms of the bazooka is in COVID really unveiled the fiscal bazooka. And we are still, despite DOGE and its attempts, it's early days to try to get things under control, there's still a ton of fiscal spending going on. So at this point in time, does the fiscal bazooka matter more than the monetary bazooka?
How many hours do we have? Because you raised a bunch of issues here. So first of all, just on the Fed effectiveness in general. So absolutely they have a bazooka. That said, that bazooka works because the market ultimately has confidence in the Fed. We may be criticizing the Fed, a bunch of people in the blogosphere might, but the market takes them very seriously. Should the market doubt the Fed,
Mm-hmm.
then this bazooka is worthless.
Okay.
Ultimately,
but people have been worried that the market has been beginning to doubt the Fed, and they think that rising yields have been a sign of that. Is that true?
Yes, but that's no,
Okay.
not on. I mean, on nuances, yes. So the long end of the yield curve, we don't know what long-term inflation will be and whatnot. They are confidence indicators in the Fed, but in a broad stroke, those things are contained. And so, if there was really a loss in confidence, then the Fed is just zipping from a straw in the ocean,
Mm-hmm.
right? And so these markets are highly levered; they're huge. They're the biggest bully out there. They have a bazooka, and by all means, don't fight the Fed. But if the market were to lose confidence, we would notice. We would notice big time. And so I'm just saying that scenario, I'm not predicting that's going to happen. But if that were to happen, we would be talking about what the hell is happening and what we can do. So another portion, like whatever it takes, and you mentioned the fiscal side, might be noteworthy to state that the presumed incoming chancellor in Germany used those very words just about 2 weeks ago or 3 weeks ago. He did that after the fiasco in the White House, and the Europeans got this idea and called to rearm. And in Germany, they had an election earlier this year. The new parliament won't be in force until later this month, but they are just this week actually passing a constitutional amendment to exceed their debt levels, and they're going to spend about €1 trillion on both rearmament in order to get it. That's half a trillion. The other $500 billion on infrastructure spending, so that you have to give out the gifts to everybody else, so that you can actually get the 2/3 majority. Mm-hmm. And so when a country like Germany, that's a fraction of the US, spends $1 trillion, it's a good chunk of change. In addition to that, the European Union wants to spend €800 billion. And then some other countries in addition to that. So you're starting to add up a good chunk of money. The reason I mentioned that is, in contrast, in the US, we got fiscal contraction right now. Doge doesn't solve entitlement issues, but it does look like there's going to be a decent dent going to be made in spending. And we'll have to see, of course, what's going to happen later in this year with any tax reforms and whatnot. But it's one of the reasons why these markets are jittery, aside from other things we'll talk about. Now, will the fiscal side have more of an impact? In order to based on everything I said, you would say yes, except in the spirit of disagreeing even with myself, I think there's a third one that will have an even bigger impact. Okay. And that is executive action. We are in an environment where we have a president who has an agenda. You love him or hate him. And in a normal world, you would have Congress dictate the budget, except about 100 years ago, some little less, but in the 1930s, then more extremely so, Congress gave the president the authority to impose tariffs, an action that should not be done by the president, by constitutional setup, but he has that power. And he doesn't just wield that power for getting a little bit more revenue. Trump already in the 1980s talked about how foreign countries are ripping off the US. And what he means with that is that there's a trade imbalance. And if I see it correctly, he is going to use the executive power to impose a trade balance. Now, the problem with that is, that it may well have unintended consequences. And the reason I mentioned in discussion about the Fed, because if you just do the math on how the current account balance works, if you by decree pretty much level out the trade balance, it is quite possible, and it might be even likely, that you're stopping financial flows. And now, to close the loop, if you have a government that has a substantial deficit, you're going to run into a problem. You can have the sort of beautiful world that Trump envisions, when you have a government that balances the budget. And indeed, Trump announced it during his address to Congress, and people laughed it off. But I would not be in a laughing mood here based on what I've seen in recent weeks here. He might just impose that. And if that is to happen, something is quite possibly going to break, because we have a highly levered system that we are re-engineering here. We're changing the plumbing of the financial system. And the Fed will have to play a role in that. Now, they may not want to play a role in that, but this pressure on the Fed might rise quite significantly in earnest. Now, if I look at the markets, you don't see that in the yield curve or anything like that. The one warning that you do see is the price of gold keeps reaching all-time highs. That is one area where you see a little bit of warning flag. And I'm not suggesting this necessarily going to happen tomorrow. Also, Mr. Trump is highly pragmatic. And so if there were a more serious issue, wouldn't be surprised. And in any case, what he does is 2 steps forward, 1 step back, 1 step sideways. But I do think, aside from to kind of make this very long story short, aside from the monetary bazooka, yet I've got the fiscal bazooka, but the executive bazooka is not to be ignored.
Okay. So let me ask you this. So obviously, Treasury is joined at the hip with Trump in terms of trying to figure out what they want this executive action to result in. The Fed is always saying it's independent. Even today, Powell reiterated that, like, hey, we just wait and see. Do you think that the Fed is actually, is there more interplay between the administration and the Fed that you think than Powell admits to here?
No, the Fed earnestly wants to be independent, but you can have mediocre monetary policy when you have strong fiscal policy. But when you have bad fiscal policy, it's just not possible to have sound monetary policy in the long run. And exhibit 1 is Mr. Draghi with whatever it takes. And we've had that before, right? After World War II, interest rates were kept low through an agreement with the Fed. The Fed needs to be independent to keep inflation low and whatnot. But if the situation is such that the Fed must help out Treasury, it all but certainly will happen, and I just say that based on history. And so there will be, and depending on who is at the head of the Fed, that resistance may be stronger or less strong. But even Paul Volcker, right, when he had his hard money policy, he had Ronald Reagan's approval. He would not have been able to do it without. So that doesn't mean that Powell is coordinating policy, but keep in mind that a year from now, a new Fed chair will be coming in. So we do have to, and of course, every politician loves to bash the Fed, right? Because you like to outsolve your problems, always somebody else's fault. But I do think, given the goal of balancing trade, it is more important than ever to keep a very close eye of who's going to succeed Powell.
Okay, and kind of where I was asking that question is you said, it seems that the new administration is trying to redesign the financial plumbing of the government, and you would imagine that they would want the Fed to have a seat at that table, at the very least, just to say, look, these are some of the changes we're planning on making. We want to give you a heads up.
Yeah, I'm not. Maybe the government, at least they say they want to go back to basics, right? But it's the financial plumbing that they're changing, because when you change the rules of trade, you affect international financial flows. And one way to think about it is that the U.S. is really a giant hedge fund. It acts like a bank. You have the capital markets in the U.S., people borrowing U.S. dollars to invest for higher yield abroad. And foreigners also get the funding in the US because of the deep financial markets in the US. The flip side of that is when you have a so-called risk-off environment, people de-lever. And so when you have shorted the dollar to buy assets abroad, you have a short squeeze. And that's why historically often, but not in recent weeks, the dollar rallied in risk-off environments. And when you put a stop or a kind of a wrench into that engine, you're going to have a profound impact on how the plumbing works. Indeed, I would argue you're threatening the reserve currency status of the dollar. It is this hedge fund attribute of the U.S. economy that gives the U.S. this exorbitant privilege to spend beyond its means. I'm not arguing whether it's ultimately a good thing or bad thing that the U.S. is like a hedge fund. What I'm saying is that you have a highly levered global financial system, and when you're imposing change, you got to be very, very careful, because you're playing with fire, and there's a risk of some things breaking along the way.
Okay. Well, all right. So the market reaction to today's news, just a few hours after Powell's press conference, market seemed to like what it heard. S&P, had been up for a bit for the day, up even more, right? So maybe we finally found a little tradable bottom here in the short term. But there's not a lot of talk. There wasn't a lot of talk at the press conference today about what you're raising, Axel, which is like, there were some questions about the slowing economy, and do you think there's a recession coming? Sounds like you're potentially worried about something bigger than that. And I know you're not saying it's definitely going to happen, but it sounds like you're saying that the price of gold might be a reflection of that, right? Which is that people around the world are saying, hey, maybe we're playing with fire here. Maybe we want to, get more in a risk-off type of trade. I guess let me ask this: when you talk about something breaking in a way that worries you, like how bad is bad? How big of a risk this is, and then the follow-up is like what's it going to take for the markets to start pricing that risk in?
Oh, this is not something the market prices in. When it happens, it whacks you out of left field.
So
right?
Total black swan.
And that's a black swan event, right? Because if the market were to signal it, we would have the market's attention. So that, which also means, because the market knows everything and prices everything in, I might be completely off base with what I'm thinking here. I'm just trying to make sense, having watched Trump for many years. He loves to use hyperbole, but directionally, he tends to not just make a point, but also believe in what he says. And he is far more effective, if one wants to use a somewhat neutral word, in how he's implementing his agenda than in the first administration.
Mm-hmm.
And then there are these little comments. Bessent, the Treasury Secretary, said, bear markets or corrections are just normal, and so the market is a little jittery. And of course, this is all in the backdrop of the market being quite expensive. I mean, I'd say yesterday I was a guest on a program where I was waiting until I was given an opportunity to speak, and I felt like it was in the wrong movie. They talked about all this misery in the market and stocks being down and this and that, and says, what are you talking about? Our assets here at Merk Investments are up from 1.6 billion to over 2 billion this year alone. And so
wow.
we are not complaining here. So things seem to be doing well. There's some stuff happening here. But as far as the economy is concerned, I mean, this can play out any way. There, I agree with Powell. We talked about kind of the slowing economy. We haven't talked much about the deregulatory efforts. So in theory, those should be boosting growth. The reason they haven't done that is because of the uncertainty. If you don't know what the rules of the game are tomorrow, you're not going to invest. And you see that when you're dependent on grants, on government grants that have been cut, but you also see that on trade, right? So the market needs some certainty. The question is, when will we be ready for that? As I might remember, people, NAFTA was all horrible, and then the next day we got the, whatever it's called, the US Mexican-Canadian trade agreement.
Yeah.
And now that's thrown out. Will we have a new deal tomorrow? I don't know. But once we have a deal, if we have less regulation, we can unleash quite a bit of growth, right? The tax changes can unleash a lot of growth. The reason why I'm careful is about this unknown, that something could, quote unquote, whack the market. Whacking the market is a CFA level 4 term, in case your audience doesn't know that.
Yeah.
And the reason why I say that is a risk is simply because the system is so highly levered. And when you throw roadblocks into financial flows, that can cause serious disruptions. Now, I haven't seen any specific proposal that will cause that, but I do see an intent here at the administration to rewire the plumbing of the financial system. And they seem to be, this is not just about whether tariffs should be 10% or 8% and then we call it a day. I think the agenda is bigger. And ultimately, I think the reason why the markets are not freaking out over this is because Trump is pragmatic and not dogmatic. And we might not actually see a full force implementation of that agenda.
Okay. But okay, we've got that big risk, right? That they get so disruptive that some of these things really break in a really big systemic way. Let's put that risk aside for a second. I think there is the reasonable risk that the economy could enter recession at some point this year because it was slowing anyways. There were some sins of the past that are catching up to us, but also just, a lot of the things that Trump's doing here, they have short-term costs to them, right? Before the long-term benefits begin to materialize. Is the market appreciating that? And I guess you could say, well, maybe that's why the market's been selling off for the past, 4 or 5 weeks, right?
Yeah, I mean, predicting recessions is difficult. I mean, some folks have been predicting it for years. As far as investments are concerned, it's not so much whether there will be a recession. It is indeed the threat of a recession. We can get that the proof with hindsight. I mean, in the US, we're the one country where we only announce recessions with a substantial lag, and it's driven by a committee rather than just by data. But yes, I mean, there is a risk of a recession. I think that matters much more whether there actually will be one. And you can position yourself and just, I mean, we've talked about this before. When you have a shallow recession, the markets can kind of look through that. When you have a more severe recession, then traditional equities tend to do more poorly. And so the question is, where are we right now? And of course, we are in a context and evaluations were high, and we see warning signals. So historically, the way recessions happened, either there's a shock, or otherwise there is a slowing economy already, and then just something pushes it over the edge. Mm-hmm. So we might have a slowing economy, a tired consumer, and tariffs, right? Or something else crazy that might happen. No, I mean, there's plenty. Should we have a recession, I think we'll get plenty of pundits coming out and saying, yeah, it was obvious that it would come, right? Obviously, it's never obvious beforehand. As an investor, it's kind of a risk assessment and how much you want to take that risk into account. I'm so busy with the things I'm doing that I haven't really had any bad feelings about any S&P going down in the meantime.
Okay, well, why don't we talk about that briefly? So nobody brought up the price of gold today in the press conference, but oftentimes gold is looked to as a mirror of confidence in what monetary policy is. Gold has had a fantastic run, and for viewers that might not be fully aware of your day job, Axel, you run several funds that invest heavily in gold or gold miners. So what has this run in gold? What message do you think this run in gold is sending us? And like, where are we, do you think, in this run? Are we due for a pullback here, or are we just getting started?
Let me give you a few answers. I talked to somebody who sells gold online, and they said they're very busy. I talked to a local coin dealer who I deeply respect. He said this is like the late 70s and very little is happening. And he said the space to watch is the premiums in the coins. When the premiums in the coins rise, that means there's a retail frenzy getting into gold. And that's his argument as to why we're in the early innings.
Okay, because they have not started really moving yet, right?
They have the premiums haven't moved. Now, obviously, many factors that drive the premiums. It's a supply demand, but it's a relevant data point, I suppose, right? The other one is flows. The gold mutual funds have seen outflows forever. In recent weeks, they have started to see inflows. Now, is that the end of a cycle, or is that just the beginning of something more interesting? If you look at the mining companies, there has been so much disillusionment in the space because especially the larger producers have disappointed so often. Just for context, for those who don't watch it so much, they had overinvested in the previous cycle, then they were told to get their act together, they underinvested, which means they now have a good balance sheet, but they have they have less of a leverage to the price of gold. They've been scrambling to catch up, so they've invested in these huge projects that are difficult to execute on time and on budget. In the meantime, and as a result of that, we are $1,000 higher in the price of gold, whereas many of the miners are at the similar valuations than $1,000 lower. Right. Now, that said, there has been in many of the gold miners an excellent run, of course, and there is some tremendous value that can be generated. There is capital is more readily available, but it's not like the market is being flooded with money. And so we are no longer at a deep depression state. At the same time, if you look at the valuation of the entire space versus the S&P 500, it still looks rather depressed. And then the final tidbit, and I have to say that because I'm biased, I am personally have been an insider buyer, and I'm on the record on that, and I haven't sold anything. So I'm positively biased here, right? So I'm not an insider buyer that has been selling. Let's put it this way. But you do with it what you want, right? I mean, it might be my personal bias. I don't now. Of course, the price of gold has gone up substantially, right? So it would not be surprising at all if we had a pullback. I do think that these risks that I pointed out with the executive action to change the plumbing of the financial system are a key driver as to why gold has marched on, because this is a new world that this market is getting to. And of course, that's in the context of geopolitical risks. To just repeat what I've said with you before on other of these interviews, I think that what's happening in Ukraine and in Gaza are just symptoms of a new era. You saw news coming out of Turkey today with the mayor of Istanbul being sacked. There are some things coming through that will make this world less stable, less predictable, which means a higher cost of doing business. The spending in Europe, they don't have the procurement channels to do 500 billion in military ramp up. A lot of that money will be wasted. The plain English way of saying that is that will be inflation. And then you have Madame Lagarde at the ECB say, in defense spending is an investment in innovation and increases productivity. So her bias is that this massive ramp up in spending is not going to be inflationary. The Bundesbank in Germany just they did an AI study on whether the ECB is dovish or hawkish, and guess what? The ECB is very dovish, right? The reason I focus on the ECB is because that's where I see the spending ramped up. But the reason why what's happening in Europe is relevant is, remember how Powell and all the other central bankers said, it's not my fault that we had the great inflation, everybody else had it as well. Well, the spending in the US wasn't just large on a US scale, it was large on a global scale. And so similarly, if you are to have, and of course some of these spending numbers in Europe are over 10 years, but if you have Europe dramatically ramp up spending, that will have spillover effect. Europe hasn't been a global growth engine for many, many years, but that doesn't mean you can't rule it out. And of course, then you have China. We haven't talked about those guys. I was just
going to say, right? China's doing the same, yeah.
They have a deflationary issues, and they are fighting it, and they're fighting it with spending, right? And so all those things are cross currents that we shouldn't ignore entirely.
All right. Well, look, obviously those may all be reasons why gold is on the move the way that it is. I'd love to get your opinion on these dots. So I've had some other gold experts on the channel of late, and we've talked about how, past number of years, central banks have really increased their buying of gold, right? But now you're starting to see countries repatriate their gold, right? Like, hey, I don't want it stored remotely anymore. Like, we want to have it in our own vaults on our own shores. And then of late, you're seeing this big movement of physical bullion, from let's put it this way. You're seeing a lot of physical bullion coming out of COMEX because people are standing for delivery. And now COMEX seems to be hoovering a ton of bullion from London, from the LBMA. So what do you think's at the core of that?
That's coming from London to COMEX. So yes, again, the topic we can spend many hours on, because there's a lot of misunderstanding how that market works. The first thing I'll say up front, this is a physical market, and so the small print matters. And just as you had negative oil prices a few years ago, there are reasons at the time that the storage capacity was reached, right? So to just go quickly through that, and I'll be glad to dive into more detail, there has been a fear that tariffs will be imposed on imports from the UK. And nobody that I've talked to thinks that gold might be targeted in that, but it might just be swept up in a blanket tariff. And indeed, the expectation is if that were the case, that gold would get an exemption at some point. But in any case, people said, well, we need some gold in the US. And so rather than getting gold in London, which we normally do, why don't we get it at COMEX? And so there has been a scramble to get gold from London to the COMEX vaults. Now, the small print starts to begin. The first thing is that COMEX is the one place where institutional gold trading happens that is actually not accepting London bars. London bars are these big James Bond-looking bars that is the currency in the LBMA system. And instead, they mostly now attract kilobars. They also do 100-gram bars. And so what's happening is that London bars are making it from London to Switzerland to be refined, and then to the US. One interesting aspect, at least to me, is that kilobars tend to trade at a small premium to a spot price of gold. And this entire excursion doesn't cost them a thing, because by the time you have the kilobar at COMEX, it's worth more than the London bar. And so it's a true arbitrage mechanism. And so they don't have any issue saying, oh, let's take it all, right? Let's take as much as we can. I should mention at this point, another great confusion. We talk about the price of gold. The price of gold, the spot price of gold that's commonly quoted, is that of an ounce of a London bar quoted by the London bullion dealers.
Right,
in
that's
London.
The London spot fix twice a day, right?
That is the London spot price, right? And so everything else is priced off that. So now you have this gold being sucked out. But the other thing to be aware of, and the reason I take so much time is because there's been so much bad information out there. So I'm just trying to set the record straight on some of these things. So if you were to have a shortage of gold, there is this wonderful mechanism called the price that will address that. So if you were to have a shortage of gold, the price would go up. So that is one mechanism. Now, in London, it's a bit more complicated because...
Which check, it is. The price of gold is going up, so check, yeah.
Yes, but yeah, it goes up a little bit, yes. And by the way, if you look at market measures, there are two measures of stress in the system. One is the gold leasing rates. They have come down from the peak. And then there's another one I'll get to, and that one has never blown up. As gold comes out of London, much of the market is being facilitated by these bullion dealers in London. And they provide the liquidity to the gold exchange traded products and other things. So what happens, for example, in exchange traded gold product is that when gold is delivered to one of these products, the so-called authorized participant delivers paper gold to the custodian. The custodian converts that into allocated gold, and then once the allocated gold is confirmed to be with that gold trust, the shares are being issued. But in order for that to happen, the these clearing banks, of course, need to have access to gold. Now, these clearing banks keep their gold mostly in their own vault, but not insignificantly sometimes with the vaults of the other clearing banks, and importantly, some of the gold at the vault of the Bank of England. And that is where the problems start to happen. When you own gold with a clearing bank, your gold tends to be on a pallet, and multiple pallets if you have a lot of gold. When you have your gold in the Bank of England, they have the gold in pallets, but if the gold changes hand from one central bank to another one, or from one of their customers to another one, they only make a computer entry that suddenly a bar of gold on this pallet belongs to somebody else. So you have these pallets. So you have these pallets where you have a bunch of different owners. Now, every bar is owned by a specific owner. Don't get me wrong on that. But what happens is you have a logistical nightmare if you suddenly say, okay, we want a gazillion tons of gold shipped out. And so the Bank of England, and they have 7 or 8 vaults in London. So when suddenly there are these requests coming to ship a lot of gold, they're scrambling. So there are weeks of delay in procuring that gold. And they want to treat all their clients equally. So the bullion banks risk that they might not have access to the gold in order to fulfill an order. And the place you would see that, if that risk were to become a reality, is in the spread, right? Because selling a bar of gold would be easier than buying a bar of gold. If you buy a bar of gold, you're not going to get it. And so the place you want to watch that is that if you see the spread in the spot price of gold widen, if you see the spreads widen in the gold products, because the big exchange traded products, they hedge themselves, and that hasn't happened. There's always a little bit of a widening of a spread around the announcement of economic data for a few seconds, but that's different. That's just the market risk, right? But
okay.
If you see a widening of the spreads, then you would have a true shortage. But again, there's a market mechanism that handles that.
Okay, so for the people that are looking at this and saying, "Hey, big deliveries at COMEX, people are getting, they're prioritizing physical, they're starting to drain the COMEX." You're basically saying we're not really seeing any signs of stress yet that we would expect to see if there was a true run on physical.
What I'm saying, it's all orderly. That's what I'm saying, right? There is nothing disorderly that has happened to date. The market is functioning, right? When there's a demand in gold, it is naturally that the lease rates go up. But the true issue would come when the spreads are widening. And again, there's a market mechanism to deal with that, right? So that is the main thing I'm saying, is that these markets are functioning as they should. And it's important. And the reason why I went into this great effort is because when there is a crisis, it's important to understand plumbing, to use that term again, right? Mm-hmm. Because then you also know whether is there a serious issue, is there not a serious issue, and whatnot.
Right. But the plumbing is not telling us there's a serious issue yet. It's still functioning as...
No, not just that. It's actually the stress has been abating. So there had been the stress in the sense that there has been an aggressive push to front run any tariffs, so to speak. So it does appear that the markets have somewhat settled down and is content of where we are right now. And of course, in the meantime, the Bank of England is trying to get its act together. By the way, these problems at the Bank of England are not new. They've been well known for over 10 years since I've looked at this in more detail. And so it's just when it comes to stress points like that, it's they suddenly become news.
Okay. All right, folks. So in the remaining minutes here, I'll start pulling questions from the live chat. So if you have questions for Axel, please ask them there, and I'll pull up as many as I can. As we transition to that, Axel, let me just ask you kind of high-level gold. Now, you're not selling. Like you said, you're an insider who's not selling, which sort of tips your hand as to where you think the price may go. But how enthusiastic are you about gold's prospects at this point in time, now that it's crossed 3,000 an ounce?
Well, the price is, to me, much less relevant. I think that the realization that the executive action might, in earnest, try to change the financial plumbing gets me to be more optimistic than I have been in a long time. I've always had somewhat of a positive inclination, but that's mostly been driven by the very simple fact that the interests of governments and debt are not aligned with those of investors. And ultimately, by the way, I'm not telling anybody go out and buy gold. It's a very volatile asset. You got to be able to stomach the risk of any investment. I mentioned gold miners, notoriously volatile. I mean, the advantage of that is you need a small allocation only to get a good diversification, but it's not for everybody. It's not for the faint of heart. So just keep that in mind. That said, I am personally, yes, I like that space a lot. I'm very enthusiastic about that space. And the crazier policymakers are and I'm not labeling anybody crazy here, but the more enthusiastic you get. Now, the one caveat I also like to mention, if I'm right with any of these more shock scenarios that might happen, we learned during the financial crisis that when push comes to shove, the rules of the game can change. And so don't think that, don't think you have a crystal ball that you can actually predict the future. And second, even if you are right, it doesn't mean that markets will behave the way that you're anticipating. It is about risk assessment and whether you deem it's prudent to do certain things as you allocate risk, and that applies to where monetary policy might go, or executive action, or fiscal policy.
Okay. Let's see. There was a question here about gold and the miners. I'm going to ask you sort of two questions. Laura asks, if the spot price of gold drops, will it hurt the miners? I mean, I think yes, in general, if it drops far enough, that eventually it'll start impacting the miners. But let me ask you this, as you answer, Axel. You talked earlier about how gold has moved a lot more than the miners to date. Some miners are still trading where they were back when gold was $1,000 an ounce lower. Even if gold remains steady here, let's just say it flatlines for the year, are you expecting a catch up in the miners?
Yes, is the short answer. But to address the question here, most of the time, of course, yes, gold and gold miners are correlated. The one thing I would like to say, though, on that topic is that you're not going to get funding for a project if you project $3,000 an ounce in gold. These projections, these business models are all based on substantially lower gold prices. Now, clearly, funding might be more easily available with gold being where it is, but if you are, when you talk to the gold miners, first of all, those guys are geologists. They are miners. They don't really care whether they're taking gold out of the ground or lithium or something else. I mean, they are nerds fascinated by the technology of what they're doing. And of course, a positive environment for the commodity they're getting out of the ground will get them into a better mood. But the management teams will focus on keeping the costs under control, at least they should, and have to budget a far lower price of gold. And so, yes, a lower gold price might hurt them in the short term, but given that the market is really not taking the profitability of these miners all that seriously, there's a lot of room that they have that they can prove themselves and they can make substantial profits. And on the current environment, even if gold was 15-20% lower than it is right now.
Well, and that's why I started with the question with the catch up, right? So, I mean, the gold price could sell off by 10% or something like that, but the scale of the catch up could still be much larger.
Yes, but the market isn't static, right? The market is valuing the ounce of gold in the ground less than it used to. And in part because it's been so often disappointed. If you think about it, the large miners, they are so huge. They need to replenish. When you produce 8 million ounces a year, you can't replenish this stuff fast enough, right? And so they're like on a treadmill. We like much more to invest in the smaller miners and development companies that have growth potential. But and usually what happens in a bull market, first the money goes to the big guys and then it goes to the small ones. The one thing you have less than you have in the past is active management. And I was actually very excited to see that in some other sectors, active managers are coming back. And ETF is not, I mean, yes, you have some actively managed ETFs, but it's very difficult for them to invest very much in the junior miners. And so this capital that's provided to the industry, yes, some others have jumped in on the private equity side and whatnot, but even or especially when there's a broader drive to invest in this market, there's just not enough skill set out there to allocate that capital to the right places. And the part of the reason I say that is the gold mining sector has a greater dispersion of returns than any other S&P sector based on our analysis. And so basically what that means that active management matters, but almost by definition, at least half the active managers are underperforming, right? And so, and the gold mining space is particularly acute to this issue. So when there's a bull market, sure, everybody's going to get some money, but I think they're going to be very, very different returns across the spectrum.
Okay, so just to decode what you just said there, if you want to play the opportunity that lies in the mining stocks, you've got to be thoughtful about it, because depending upon where you invest in that market, you could have very, very different returns.
You've got to have thoughtful money, I think, yes.
Okay. nice pandering to me. Thank you.
Isn't that what you were setting up?
All right. Well, look, as we start to wrap up here, again, Axel, I know it's a super busy day for you, super busy time for you, given all that's going on with gold and everything else. But also, Fed days are always busy for you. I still very much appreciate you making the time to come on and help decode things here for this audience. And folks, if you like these, swift reaction videos to Axel once the Fed news is out and would like us to continue this going forward, please let us know in the live chat. And if you want it to continue, we'll keep at it. As we start wrapping up here, Axel, I guess kind of bringing it back to the Fed, how has today's developments, if at all, sort of changed your thinking about the Fed and moving forward from here until the next FOMC meeting?
Not really at all. I mean, of course, it's interesting, the change in wording they have. It's really sad that they're not getting people up to speed on what they do in their 5-year review. For those who don't follow this stuff so closely, some of you may recall that the Fed several years ago announced that their target is based on a backward-looking inflation scheme. They still have that scheme on the books. Of course, they're not following it. And they now are going to come out in a few months with a new framework. I mean, I attend some of these conferences where some of this quote unquote thought leadership is supposed to take place. I haven't really seen anything that would get me to feel that they're going to change substantially. So, but ultimately, of course, it doesn't matter what we complain about. What matters is what they will do. And I think Dudley, the New York Fed president, is right. They'll just be late in whatever they do, which means on a practical basis is they'll have a slightly tightening bias. And that means the economy, all else equal, is going to continue to slow down, except, of course, we don't have all else equal. We have some substantial factors that should slow the economy further with the economic uncertainty and the tariffs. And then we have a tailwind at the other end of the spectrum from deregulation and the potential tax changes, right? So that's where we are. And you can and then, of course, to me, you have the systemic risk that's increased with all of that. But maybe that's just my own dreaming here. But that's where we are.
All right. Well, I hear you're saying, look, you on a net basis, you think the factors have become more concerning. Even the potential tailwinds you talked about, those will take time to manifest, right? I mean, yeah. Maybe more than a year,
Well, let me phrase it differently. Somebody mentioned somebody else how well gold miners have done it. Well, doesn't it mean you should sell, diversify, right? Rebalance your portfolio. And by all means, there's always an opportunity to take some part of your budget, right, and reallocate it to fund something else. But it's not like my enthusiasm for the S&P 500 has gone up in recent weeks. So that's just to keep that in mind. Now, of course, the time to diversify is, of course, during the good times. So anybody thinking of diversification, I'm not going to talk you out of it.
Yeah. All right. Well, look, we will end it on that. Axel, looks like people would very much like you to keep doing this. So as long as you're willing to do it, we'll have you on here. I actually don't have the calendar in front of me here. Do you know off the top of your head when the next Fed meeting is?
We have May 7 as the next meeting date.
All right. Well, Axel, I'll meet you back here on May 7th. Everyone else will be doing this same thing in the same time, same place. To make sure, if you're not already on the list, go to thoughtfulmoney.com. It's my main website, and at the top of it, there's a link there that says newsletter. You can sign up for our free Substack, and an hour or so before we go live with this thing, I let everybody know. So that's how you can get informed of these going forward. Axel, for folks that would like to follow you, where should they go?
Yes, at Axel Merk is my Twitter handle, and I still call it Twitter. And then at merkinvestments.com, our website is our corporate website. You can learn about what we do. We have a newsletter. I can't talk about the products we manage here, but you can access them through the website as well.
All right, great. And just to go through some of these handy URLs I have here, here's the link to thoughtfulmoney.com. Like I said, if you hit the newsletter link at the top of the site, you can sign up for our free newsletter there. Also, while you're there, if you want to get a free consultation from one of the financial advisors that Thoughtful Money endorses to figure out how to position your portfolio for this future that may lie ahead, as Axel has laid out for us, you can use the short form there to sign up for one of those. And just a quick reminder, if you didn't see it, we had a phenomenal conference this past weekend, Thoughtful Money Spring Online Conference. If you want to get the replay of that, just go to thoughtfulmoney.com/conference. With that being said, though, Axel, again, thanks so much. Always a joy to spend time here with you, my friend, and we'll see you on May 7th.
My pleasure.
All right, everybody else, thanks so much for watching.